So now we're looking at chapter 4, which entails the general journal and the general ledger. Fun, right? So we're going to look at how to record transactions in the general journal. We're going to prepare what we call compound journal entries. And then under the general ledger, we're going to post journals to their general ledger accounts. We're going to learn how to correct errors made in the journal or ledger. And then, of course, we also always have new accounting terms in our chapters. So the entire accounting cycle. We have looked at step 1, where we analyze and classify transactions. We've learned how to journalize those transactions and looking at posting transactions to the ledger. Then we're going to look at preparing a worksheet, financial statements, adjusting entries, closing entries, a post-closing trial balance, and then being able to evaluate and communicate financial information. I don't know about you, but that sounds like a whole lot of fun to me. All right, let's rock and roll. So recording transactions in a general journal. So a journal is like a diary of business activity. So businesses have different transactions that occur. There are different types of accounting journals. So transactions are entered in the journal in chronological order, so date order. So in order to record a business transaction, we got to go through several steps. First, we have to analyze the financial event. So when I say a transaction, financial event, those are the same thing. So when a business engages in any activity, that has something to do monetarily, it's called a financial event, also a business transaction. So we have a transaction. It must be recorded. So first we got to identify the accounts that are being affected. So whether it's cash, whether it's equipment, then we classify those accounts that are being affected. So cash is an asset. So that's classifying it. And then we determine if the amount of that transaction is increasing for that account or decreasing. Now, based upon that, we're going to learn some rules of debits and credits. And then, based upon how we've analyzed the financial event, we'll determine which account is going to be debited and for what amount, and then which account is going to be credited for what amount. Then we're going to make the entry in what we call the T account form, which looks like a T. And we're going to record the complete entry in general journal form. So let's take a look at how this looks. So our transaction on November the 6th, Trade and Eli withdrew $100,000 from personal savings and deposited into the new business checking account for Eli Consulting Services. So first of all, we have to determine what accounts are being affected. So the first account is cash because we see that Eli withdrew $100,000 from personal savings. So that's cash. So that's the first account is cash. Now this doesn't say cash, but when it says he deposited into the new business checking account, we know that we deposit cash. We can't deposit rocks in a checking account, can we? So that's the first account. And then the second account is when he puts it into the business, then he has gotten capital within the business. So that means capital is money that we have to run our business. So our second account is capital. Now, it doesn't say capital here, but you're learning that when someone invests in a business, then that is capital. So we've identified cash and we've identified capital. So cash is going to be debited and we're going to put it in the debit amount. So it's kind of like, it looks like a T here. We know the left sides are debits, the right sides are credit. So cash is being debited and we put the amount. Then we indent into and put Trayton Eli, comma, capital, and that's credit. And so now we've done our journal entry. So let me point out 5 things for this journal entry, and it may be on the next page, but I get so excited when teaching, I get ahead of myself. So there are 5 components to a journal entry. The first is the date. So notice this is November the 6th, so we put the date. The second is you list the debit first and then its amount. You indent in 2 characters. Notice this is indented in, and you list the credit and its amount. There is a 4th element that's not here, but it's called the description. And the description lets you know what's going on in this journal entry or this transaction. And then we have this 5th element called the post reference, which is going to be filled in after we post to our general journal. So there are 5 elements. So right now, we're just showing you how to create this general journal. But there are going to be, so this journal entry, I'm sorry, there are going to be certain criteria that must be followed in order to get this. So let's learn more about that. So here, this is where we're actually adding the description. So that's the 4th element that I referenced earlier. It should, whenever possible, the journal entry should refer to the source of the information. So this says investment by owner memo 01. So there was a memo that was created. And so we put that information in. Now, the description is typically different from bookkeeper to bookkeeper or accountant to accountant. It's really what you put in to identify what's occurring here. When I was in corporate, you could tell my journal entries because I always abbreviated the word received with REC apostrophe D. So document numbers are part of what we call the audit trail. We always want to document things. So on November 7th, Eli Consulting Service issued check 1001 for $5,000 to purchase a computer and other equipment. So what are the 2 accounts? The first account is a computer. He purchased a computer. We're going to call it equipment. We'll classify it as equipment. And he used cash to pay for that equipment. So you're probably wondering, well, how you knowing what is a debit and what's a credit? We are going to cover that in just 1 second. So again, we have our 5 elements. We have our, well, let's step back. So equipment is an asset. That's a type of asset. And the asset is increasing because we received equipment. We didn't have equipment at first. We received it. It's increasing. Our cash, we're paying cash out. So that means our cash is decreasing, and cash is also an asset. So we've identified the account, we've identified the account type, and we've identified how it is moving. It's increasing or decreasing. So now we do our journal entry, and I am going to tell you how we are learning these concepts. So equipment is going to be our debit. We indent into and do our credit, and then we put our description. Now notice that your debits must equal your credits. So you may have multiple debits and multiple credits, but they must equal each other, okay? So this is when we purchase equipment on credit. When we purchase something on credit, it means we owe money. When we owe money, it's a liability. And the liability that is typically booked is called an accounts payable. So now we have information where we can create a journal entry for purchasing equipment on credit. Equipment is an asset. This asset, well, equipment is the account. It's an asset, and this asset is increasing, and therefore it's a debit. Accounts payable is a liability. Our liability is also increasing. You said, well, we owe money. I know we owe money, but how much money did we owe at first? Nothing. How much do we owe now? 6,000. So the total amount that we owe is increasing. So that's how you look at liabilities. So we put our equipment, 6,000 debit, our accounts payable, 6,000 credit, and then we put our description. Cash purchases of supplies. So we have Eli Services purchasing supplies with check 1002. Anytime we use a check, it is considered cash. Cash is an asset, so that's one of our accounts, and it is decreasing. Supplies is another account. A supply is an asset, and our asset is increasing. So anytime you have an asset and it increases, it's a debit. Anytime you have an asset and it decreases, it's a credit. That is the rule of balances within our accounting structure. So assets, put this in your mental Rolodex or in your notes. If an asset is increasing, we will list it as a debit. If an asset is decreasing, we will list it as a credit. So we're learning how I am able to determine if it's a debit or a credit. So payment to a creditor. On November 30th, we paid Office Plus $2,500 in partial payment of a particular invoice, check 1003. Please note that in your general journal, always enter debits before credits. So we know that if we owed money, it was an accounts payable. And so now we're paying off $2,500. And so we're using cash to do that. So that's one account. Our cash is decreasing. We just define assets that if they increase, they are a debit. If they decrease, they are a credit. So cash is going to be our credit. And then accounts payable. We learned that in the other journal that it was a liability. And when we first got the liability, it increased on the credit side. So if we pay some of that off, then it decreases. Liabilities, the rule for liabilities is they increase on the credit and they decrease on the debit. And so because we're paying it off, the accounts payable is the debit, and then the cash is a credit because it's decreasing. Again, always remember to put your debits before credits, and we must always have debits to equal credits. That is called double entry accounting. Here's another one. Eli wrote a check. So remember we said checks are like cash. $8,000 for prepayment for rent from December to January. Anytime you prepay an item, so for rent, or typically it's rent or insurance that you pay in advance, it is going to be listed as an asset until you have used it up. So because he has prepaid rent for December and January and November, we're going to list this as an asset called prepaid rent. And we already said that assets increase on the debit side, which is why we put the 8,000 on the debit. And then we're paying cash, and cash is decreasing, and assets decrease on the credit side. Services paid performed for cash. So we already know that one category is cash, and our cash is increasing, and cash is an asset, and assets increase on the debit side. The new account that we're learning is fees income. Fees income is a type of revenue. So you're going to have a lot of different types of revenue. Revenues are just monies that a company makes. So the rule for revenues are that revenues increase on the credit side. And if they happen to decrease, they decrease on the debit side. But revenues typically don't decrease because you don't take revenue back. You may have to issue a refund, but that hits a different account. So we got our two accounts, cash is increasing, our revenues are increasing. And so the rule of thumb for revenues is they increase on the credit and decrease on the debit. So now we provided services, but this time on account. So that means that the client is going to pay us at another time. When a client agrees to pay at another time, they owe us money. And when they owe us money, that's an accounts receivable, which is an asset. So they owe us money. What they owe us is increasing. Assets increase on the debit side, which is why accounts receivable is your debit. And then we have revenue that's increasing, and we just learned that revenue increases on the credit side. So we're just going through a few more so you can get acclimated. So we receive cash. We already know cash is an asset, it's increasing. That's going to be our debit from a client, credit client on account. So this client is paying off some of what they owe. And so accounts receivable is what they owe. And it increases on the debit side. So that means if they're paying this off, it's now decreasing. And assets decrease on the credit side, which is why that is a credit. So if an account increases on one side, it decreases on the other. So we pay salary. When we pay salaries, we book it as an expense. Expenses increase on the debit side. So I know we're saying we're paying the salaries out, so where our money is decreasing, you're right, our money is decreasing, but the total amount of salaries that we're paying out is increasing. So all expenses increase on the debit side. So that's why our salaries expenses are debit, and then our cash is decreasing. And we know that assets decrease on the credit side. We pay utility bill. So in cash, so this account is utilities expense, increasing 650 debit, cash decreasing 650 credit. So the owner now withdrew 5,000 from the company. So now we have our drawing. So when we add money, it's called capital. When we take money out, it's called drawing or withdrawing. And so the owner is taking 5,000. So our equity is decreasing. And then cash is also decreasing because they're taking the money out. So now the company doesn't have as much capital as it once had. Now let's look at preparing compounded journal entries. This is when you have multiple accounts at once. So sometimes you may have one debit and 3 credits, or 3 debits and 1 credit, or 4 debits and 4 credits. That's called a compounded entry. But what we must remember is that the debits must always equal the credits. And we do the same process by looking at the business transaction and walking through and identifying the accounts. So for this one, the firm purchased equipment, ding, 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 ding. So equipment will be our first one of our accounts for 5,000. Issued the check for 2,500. So they paid partial. So the equipment value was worth 5,000. They paid 2,500 in cash, and the other 2,500 they agreed to pay in 30 days. So we got 3 things going on. Equipment asset increasing. That's our debit. Cash decreasing. Asset. That's a credit. Now, this other 2,500 is when we're going to owe money. We said that owing money is a liability and it's accounts payable, and accounts payables increase on the credit side. So now you got your 3 accounts: equipment, cash decreasing, accounts payable increasing. This 5,000 equals this 5,000. And so our journal entry is in balance and we have completed it. And this is what's called a compound entry. So let's talk a little bit about ledgers. The ledger contains a separate form for each account. And the third step of our accounting cycle is now taking our journal entries and posting it to the ledger. This is just the process of transferring data from the journal to the ledger, which is called posting. So what is posting? Posting is the process of transferring data from the journal to a ledger. And then this is where that post reference number, the fifth element of the journal entry, is going to come into play. So in our ledger, this is the account form, and you'll notice it'll have the name of the account, cash. It gives it a number. This is the chart of account number that identifies it. It has columns for the date, the description, our post reference number, debit, credit, and then we also have a balance. So every time we put an entry in here, we update the balance. So we're going to take the information from the journal entries and post it to the ledger account. So there's going to be a ledger account for each account, for your cash, for your equipment, for your capital, for your withdrawal, for your accounts payable, for your revenues. There's going to be an account for each. So now we're posting. So we're going to enter the date of the transaction. So let's actually go here. So step one, here's our journal entry, equipment and cash. To post to the journal, we take the date, we put it here. So notice the account is equipment. Right here, this is the account for this general journal. It has an account number here. So what we do is we take this amount up here, this date, put it here. You don't have to do a description. Typically, we don't. And then you will take the amount of equipment, and it's a debit. So you will put the debit amount here. I'm so not good at freehanding. And then you will update the balance here. So because equipment is increases on the debit side, you would have a debit balance here. Okay. And this is, we just posted. Now, once we post, this number is going to go into this post reference account and it fills in like this. And again, the next slide might actually do this, but I get so excited in teaching this that I get ahead of myself. So the post reference number here goes, it also fills in here. So this says J1. So this is just saying general journal page 1. And the reason why we have post reference numbers is because if there is an error, we want to be able to go back and find where that error occurs. So if I'm looking at this journal, this entry here, I can say, oh, this was wrong. I could go look at the initial journal entry and do my correction. And so notice we post the 5,000 here, debit balance here, and we push this post reference number back here. See, I told you, I figured it will probably already be here. So in the general journal accounts, the balance sheet accounts come first, and then the income statement. So you have assets, liabilities, owner's equity, then revenues and expenses. So the order of accounts speeds the preparation of our trial balance and our financial statements up because we'll know that when we look at it, we'll see how we create our financial statements, and you'll see the correlation that we're talking about right here. So what happens if we make an error? Sometimes errors are made when recording transactions. A correcting entry must be recorded to adjust the account and erase the initial journal entry. You do an update. So erasures are never permitted because it's like you're erasing history, and we agree to resolve the error. So on September 1st, an automobile repair shop debited office equipment within this shop equipment for $18,000 by mistake. So they posted it to the wrong account. The debit was posted to the office equipment in the general ledger. So a correcting journal entry must be journalized and posted. And so what we're going to do is just move it from the incorrect account to the correct account. And this is how we do that. So office equipment, this was the original error. We booked it to office equipment. It should have been shop equipment, okay? To correct it, we remove it from office equipment. And so remember, equipment is an asset. Assets decrease on the debit credit side. So that's why we're debt crediting this. But then we put it to the correct account, which is shop equipment. So it shifts it from office to shop equipment. And this is a correcting entry. And notice that we can always go back and see that we had accidentally put it in office equipment, but we have a record of showing that we corrected it. And there you have it. So join me for our problem.